Okay, good morning, everybody, and thank you for joining today's session. Again, my name is Adam Goldstein. I'm the Chief Business Officer at the Federal Home Loan Bank of New York, and we welcome you. Just a few quick notes before we get started. If you have any questions, please submit them at any time through the question box, and they will be answered at the end during our Q&A session. In an effort to continually enhance the programming that we provide to you, we ask that you please complete a survey, which will come at the end of this webinar. Some of the past survey results that we have received resulted in the actual webinar that we're hosting today. Members were interested in credit and collateral and other content, and we're going to be doing that in the future webinars to come. We value your input and try to cater these sessions to what you, our members, are interested in. We will also be sending out an email with a recording of the session, as well as a link to download the presentation. If you're interested in scheduling a one-on-one session on a particular topic or want an economic update from our financial economist, please reach out to your relationship manager for more information. We also encourage you to visit our financial intelligence library, where you can find articles, podcasts, recordings of past webinars. We've also created a dedicated COVID-19 information page, which is filled with up-to-date announcements from the FHLBNY with materials ranging from the $5.90 dividend that we just paid to you, our PPP is eligible collateral, and the latest on our disaster relief funding program. We invite you again to join us next Thursday for the same time at the same time as we continue our webinar series, and we will further the narrative around PPP as we enter the phase of PPP dealing with determining forgiveness. Until then, we'll focus today's session on collateral. We at the Home Loan Bank wish you and your families and colleagues good health and safety above all. With that, I'd like to introduce Tom Citino, Vice President of Member Relations, to kick off the webinar. Tom?
Thank you, Adam. Good morning, everybody, and thank you all for joining us this morning for this webinar. So today we'll be discussing our collateral practices during this current crisis and how things have changed to adjust to this new world in which we're operating. So since the beginning of the crisis, demand for advances spiked significantly, especially at the inception of the crisis, where there was great uncertainty as to how things will unfold. And also members, in addition to having a spike demand for advances, they also had a increase in demand for pledging collateral in order to prepare for both the contingent situation and also to support strategic initiatives. So since the onset of the crisis, our collateral team has been taking action to adjust to the new operating landscape, and they've been looking to make accommodations to help members, but at the same time maintaining a certain discipline to protect the cooperative. So these efforts happened immediately, and examples include addressing our members' forbearance programs. Each member has a different forbearance program, so that's been very challenging to the group. Also adjusting to non-standard closing practices of submitted collateral, so that there's new things happening, and there's new sets of data and different closing docs for certain loans. So we have to make accommodations for that as well. Also, we've been exploring the new collateral type of the Paycheck Protection Program loan collateral, and like Adam mentioned, we're accepting that now. And also, we've been reviewing haircuts and assumptions and frequency of collateral valuations, and also altering collateral review schedules and methods. So there's been a lot of work done, and the work continues. So with that being said, let me turn it over to Brian Gallagher, Director of Collateral Analytical Services, who will address the new world we're operating in from a collateral perspective. So Brian?
Thank you, Tom, and good morning, everybody. Thank you all for joining us this morning. I did notice a few familiar faces on the attendee list, and it looks like we have a pretty good cross-section of members represented here today. I guess I would start out saying I'm not going to lie. I never envisioned doing this type of webinar from the confines of my bedroom, which I'm currently barricaded in, and with specific instructions to my 3 daughters and my dog to not go through that barricade. But I am nervous about that, so hopefully they'll comply. We want to take this time today to walk through some of the changes in the collateral area that have taken place as a result of the current crisis, as well as talk through some of the new challenges that we face, and I'm sure you face, hopefully return to whatever the new normal is. As I'm sure you're aware, our bank is operating at essentially a fully remote posture. However, the robust continuity planning at the bank has enabled us to operate, I would say, at essentially full capacity. The one area in specific to collateral, which is not operating at 100%, is the challenges around the handling of physical mortgage documents. I'm sure many of you are experiencing similar challenges in this regard. It's interesting, the mortgage world has made a number of significant technological advances over the years, but the one area that seems to remain stubbornly stagnant is the continued use of paper mortgage files. I also wanted to say that I've been actually quite impressed with the resiliency of essentially all of our membership. I guess you've all seemingly put great thought into your own continuity planning in terms of providing collateral data information to us on a monthly basis. We thought we'd have some exceptions, and we haven't. It's been impressive given the current operating environment. So moving to the next slide. So what have we seen? What are we looking at over the last few months? Number one, increased pledging activity. This is pretty much across the board, from small members to large members, and it's across all asset types. Seen a ton of new securities collateral come in, ton of residential collateral, HELOC collateral, commercial real estate collateral. Much of it was pledged to support new borrowings, as Tom alluded to. But just as importantly, a lot of it was pledged to provide additional borrowing capacity, which is important to members. We understand how important that is to members, particularly in the collateral area. But it becomes even more important in times of great unknown or great stress that we've seen starting in March. Tom mentioned the SBA Paycheck Protection Programs, PPP, that are now eligible collateral. I know this has been a Herculean task for many of you, and has occupied a great deal of your resources. It has here, certainly not to the extent that you guys have gone through it, but hopefully you're aware that the bank did announce that we were accepting PPP loans as of May 7th. This is in response to a great number of member inquiries on this seemingly very important new program. Supporting our members through the acceptance of forbearance. This is certainly at the forefront. We started receiving calls on acceptance of these loans really almost from the very beginning of the crisis. The bank has and will continue to provide great flexibility in acceptance of these loans. As we know, these are temporary arrangements. We just don't know how temporary they are given current circumstances. Lendable value changes. Certainly challenging in the unknowns of this brave new world. This crisis has created certainly vast uncertainties in the economy, and the fallout will certainly negatively impact the mortgage values. I think we just need to determine, what that impact is in the short term and in the long term. Finally, operational challenges. I'm sure you're going through as well. For us, particularly being able to perform quote unquote on-site reviews. We're certainly not going on site during this time, so I may have to actually change the name of that review process. And then obviously moving, for those of you that deliver loans into our vault in Jersey City, continuing to move the files in and out has also provided additional challenges. Moving on to the next file. These next few slides I'm going to walk through are essentially our review to just give you a sense of the size and scope of the operations here at the Home Loan Bank of New York. The overview section slide. This slide gives an overview of how much collateral we have. So I think we're up to approximately $379 billion at the end of the first quarter, just to give you the magnitude of how much collateral we have. And that's grown by about $34 billion in the last year alone. And I think the first quarter, I think we took in about $20 billion of new collateral. So as with you, we've been quite busy. Next slide is simply the collateral types refresher. I'm sure many of you are familiar with the types of collateral that we accept, but certainly reach out to us if there's any specific questions on assets that you are looking to pledge. I know there's certainly nuances, as we all know, in the mortgage world, and we get a number of requests throughout the year. So please feel free to reach out to me and my staff, and go through those familiar names with you towards the end of this presentation. Next slide. This is, again, going through our $380 billion. What do we have pledged? Obviously, we accept our largest chunk of collateral is going to be in our residential 1 to 4 first lien collateral. But also, given the fact that we support the New York area, we take a tremendous amount of multifamily collateral, probably the most in the home loan bank system. Access to liquidity. This chart shows the overall growth in member pledge collateral through the years. So you can see that as we've grown the advanced business, we've obviously had to grow the collateral business, and we're up to get us to the $380 billion. Also shows what Adam likes to refer to as the dry powder. I know this is we understand the importance of collateral of members having additional availability to borrow, and this is why we work on this essentially throughout the year, so that we hopefully are ready for things that happen, things like this crisis happening. So this is what we strive to focus on throughout the year. PPP loans as collateral. Obviously this is forefront of the media, and everyone's heard about this program. We had to wait to get regulatory approval in order to take the PPP loans as collateral. And a lot of the requirements that we've sort of laid out here have been dictated to us by our regulator, the FHFA. But there's 20% of borrowing capacity, 10% haircut. We won't be revaluing, so that 10% haircut will always be off of the UPB. We're going to restrict. There are restrictions on which members can participate, and then we believe, and I think Adam alluded to this earlier, we believe most of this collateral will be short-term in nature, as I think a lot of it will be forgiven, but certainly some of it will stay on as a 2-year loan, and we will continue to accept those. We just have the one codicil that we will not accept delinquent loans. So we've had a decent amount of interest in this over the last couple of weeks since we've made this eligible. This, in terms of pledging it, please coordinate with your collateral analyst. Anthony Cobell runs the group, and I'm sure most of you are familiar with, if that pledge mortgages, are familiar with Andrea and Ed and Gio and Alex that support your various loan pledging. So we're asking for pretty basic PPP loan information laid out on this chart. We're updating members' balances on a weekly basis, and obviously now we're updating on a positive level, meaning we're accruing more collateral as more PPP goes out the door. At some point during the forgiveness process, that collateral will obviously go down in value, and will require the members to communicate that those loans have been forgiven and they're no longer obviously eligible collateral. Pledging forbearance loans. As I mentioned earlier, this has been really important, a really important initiative for our members, reaching out to ensure that they can still pledge this collateral. And our regulator has, I think they really stepped up. They understood the importance of these various forbearance programs, and they've allowed us quite a bit of leeway in accepting these, and we're going to provide that same flexibility to our members. I think the important thing for us is just making sure that you reach out to us and let us know that you're participating in these programs, and are currently making sure that you code the loans correctly. And what we're really looking for there is to make sure that you, if you are pushing through your next due date, that you're keeping your last paid through date on the loan. So we just understand the sort of the length of the forbearance for each of the loans. And then additionally, the Home Loan Bank will work with our members who have closed mortgage loans during the pandemic using quote unquote non-standard practices due to the unique operating environment caused by COVID. We fielded a number of inquiries. Again, we ask that you notify the Home Loan Bank and get approval prior to pledging those. And a lot of that's just so we can note this for our files for when we go out and do our on-site review of your institution. So a lot of you probably wonder how exactly you pledge collateral here, and what comes out on the other side is how much you can borrow against it. And this is kind of the pictorial that we have that sort of hopefully helps you understand how we get from an unpaid principal balance to the lendable value. So starting from the left, we establish a UPB. We establish that UPB by either accepting a security in and taking the UPB as a security, or we get a loan pledged in the listing process and have a UPB established that way. Moving to the right, market value. We currently value all of our securities on a nightly basis. We value our residential mortgages on a monthly basis, and we currently value our commercial real estate on a quarterly basis. The next step is the base margin. We assign base margins at the asset level type. We keep those so those are standard base margins for all of our members. And again, they're at either the residential, commercial, multifamily, or in the case of securities down at quite more granular levels. The next step, and this is obviously only applied to members that are pledging mortgage collateral, is our on-site review, which I'm sure most of you are familiar with. We go out and take a sample of loans and calculate an on-site margin to account for any issues that we find during the review. Finally, we have something we refer to as the other member margins. This is not used. This is used fairly sparingly, and this is applied to account for any changes in the underlying member credit. So breaking down the pricing on the loan side, I've kind of lived a chart here of our, and it's a pretty long history of our residential pricing. The bank prices its residential portfolio on a monthly basis. We utilize a third-party pricing vendor, MIAC, to obtain the pricing levels. We also benchmark MIAC with other sources to ensure the reasonableness of those prices. Prior to the crisis, the resi mortgage market was in really good shape with solid credit performance, ample liquidity, and a very strong underlying housing market. This can be seen through the essentially par pricing that we applied to most of our loans over the last few years. So what happened starting in late March was that liquidity took obviously a fairly large hit, particularly in the non-agency market. So we saw spreads blow out in the jumbo market, which is obviously a large percentage of our members' portfolios given the New York area, as well as non-QM loans and HELOC loans. The markets have seemed to stabilize somewhat, particularly given the Fed support and a lot of their actions. We're hoping that the worst of the price deterioration, which you see at the far right of the chart, is behind us, but it's very early and it's hard to determine exactly where the future lies. I had mentioned earlier we would be accepting forbearance loans, and one of the reasons that we were asking for specific data to track these is that we will be accounting for pricing differences on those loans. And you know, it's hard to determine exactly how much you would adjust the price on a loan in a forbearance, but to give some benchmarks, LLPAs from the agencies, from Fannie and Freddie, seem to indicate somewhere in the 500 to 700 basis point range. So that might be a reasonable benchmark. But again, we're kind of too early for us. We haven't really gotten into that stage yet. We're still sort of collecting the data on how much of our members' portfolios are in these forbearance programs. Next slide. Similarly, CRE pricing. We keep in the far left. It shows sort of the last crisis that we went through and how bad things actually got back then. The bank prices its CR loans on a quarterly basis, utilizing a third-party pricing vendor, DebtX, which we also benchmark for reasonableness. However, since the onset of the crisis, we have increased the frequency of our evaluations, and we may move to more of a monthly time frame, at least until we have some more clarity on the path of the economic recovery. Similar to the resi market, the CRE market was also very strong pre-crisis with excellent performance on the credit side, strong fundamentals, particularly in the multifamily space. I mean, I think there was some challenges in the retail space. Again, starting in March, there was some concerns around liquidity, but much more concerns about this asset class, given not only the impact of the current economic challenges, but also the longer term ramifications of the crisis on office space, retail, hospitality. Again, it's the notion of the new normal. I'm sure you've all seen a lot of pundits are coming out and some very negative predictions on the future of the commercial real estate space. We're monitoring that, and we certainly do see that there's going to be changes. We're trying to distinguish the sort of the short-term economic impact of this crisis, and then the sort of the longer-term, I would say, longer-term operational challenges of filling some of these spaces, and we'll see what the new normal, brings us. Base margins. How do we come up with them? What do they account for? We assess our base margins on a quarterly basis, and we measure such things as price volatility by asset type and try to account for things like administrative costs associated with liquidating the collateral in the very, very unlikely event that we would need to go that route. One of the questions I've been asked, and not just during the crisis, but this I get asked as members do their liquidity planning is, are you going to dramatically change your margins during a crisis? I can tell you that we've built our margins to withstand crises like these. Now, I don't necessarily think that we foresaw this type of crisis, but we did purposely establish a fairly conservative margin so that we think we can withstand the type of crisis. I can't 100% promise we won't, but I think that our methodology would look to account for the changes in collateral values through the pricing mechanism and not through the base margin process. So hopefully that holds up. The on-site review process. For those of you that are pledging mortgages, you've either been through this or you'll soon be through this. I'll list here when we come on site, the things that we look for, and credit characteristics of the loan, payment history, the legal docs, an overall operational profile of your organization, and making sure that all of the loans that you pledge are eligible. So obviously a big challenge for us since the onset of the crisis is getting people out, quote unquote, on site to review. So to the extent possible, we are attempting to conduct our collateral reviews remotely. So we're asking members to send us the scanned docs, and we're able to work off that. And we've actually been fairly successful with a number of institutions in completing essentially all of their review, with the exception of verifying the legal docs, which we still by regs need to go on site and quote unquote verify the original legal documents. So what we've done is we'll complete essentially 95% of the review, and then at some point when we're able to get out to see members, we'll go on and complete the remainder of that review in terms of verifying the legal documents. A number of you have indicated that you can't. It's just not possible. Not everything's imaged, or some of your older loans aren't imaged that potentially we pulled the sample from. Or we understand that, and we have postponed a number of reviews to the second half of the year, and we're already starting to have some conversations to see how members are going to prepare to reopen and eventually accept teams that come on site to look at these loans. And again, I think this is probably an opportunity for us to look at some of the practices that we do in terms of whether we need to physically send people or as many people as we currently do. So this is something that we're certainly looking at. Just something that I think was more at the forefront before the crisis, and certainly something that our regulator has stressed, and that's around the LIBOR Sunset. So I just want to briefly discuss this risk, which is looming on the horizon. And it will impact, obviously, a number of financial instruments, including, for us, adjustable rate mortgages. Now, I know some of you do not offer adjustable rates, or you don't utilize LIBOR. You utilize constantly maturing treasury or or the home loan bank rate or some other index. So for you, this is not a looming risk, so you can maybe stop listening for a minute. But the LIBOR sunset is currently scheduled for the end of 2021, as I'm sure you're aware. We've included some of the actions that the FHFA has announced in regards to acquiring loans through Fannie and Freddie. And obviously the FHFA is our regulator, so we anticipate this being an important issue for them as we get closer to that sunset date. We don't anticipate taking any actions on the LIBOR index loans in the near future, but we are, and we've noted to our regulator, we are continuing to monitor the market to determine if there is a need to adjust collateral values in the future. Again, it's an important issue for our regulators, which makes it an important issue for us. So we're also, as we come on site and do our reviews and look through the sample, we are talking with the members that have LIBOR-based loans. We're reviewing the ARM notes to ensure that they contain proper replacement index language. So it's a fairly complicated issue. I don't think anything has emerged in terms of what index or will be used going forward. And SOFR has been thrown out there, and it seems to have some traction, but then there's other challenges in sort of pulling out LIBOR and posting SOFR into a mortgage. So I know there's a number of task force at the NBA level, task force at the Fed level, which the Home Loan Bank participates in. So hopefully we'll have a consensus emerge at some point over the next year and a half, and we can move seemingly, hopefully, operationally. We won't have too many issues moving from one index to the other. So finally, I wanted to add a collateral reference and contact sheet. So I wanted to point out some of the useful resources for your reference. Hopefully you're familiar with the members product guide, which can be assessed through your one link. In addition, we have a number of collateral forms on our website under the member section. And finally, I just wanted to, I actually wanted to give a quick shout out to my staff. I think they've done a really good job at adapting to their new environment and supporting our members through these tough times. And hopefully you agree with me on that. But I wanted to go through some of the names you probably are much more familiar with than myself. But in terms of any questions that you would have on collateral valuations or haircuts going forward, Amy Cison and Ingen Incy are excellent resources for that. In terms of new pledges and document delivery, I know a lot of you are familiar with KISA and obviously Gabby in terms of getting files delivered into our vault. On the collateral analysis side, Anthony Cobell is the manager of that group, and that would be who you would contact for mortgage listing issues, data exceptions, PPP pledges, forbearance reporting, et cetera. So I'm sure you're all familiar with his team as well. Finally, for on-site reviews, on the residential side, Mary Alvarez is the manager there, and on the CRE multifamily side, it's Ken Knight. So that actually concludes my presentation. Tom, I think we're going to walk through some questions.
Yeah, we have a couple of questions in the queue. I just had a question myself, Brian. Thanks for the great presentation. Covered a lot of great territory. One thing I wanted to ask about is some members have asked, and just to get some clarity around the issue where some members have to pledge their loan collateral in a collateral category, which we call in possession, where legal docs have to be submitted to our vault. Are there any operational hurdles? Are we still operating business as usual with that, or is there a new set of criteria members need to understand, whether either submitting loans or withdrawing loans from their collateral pool?
Yeah, Tom, it's I kind of mentioned it briefly, but yeah, it's been quite a challenge because we obviously have to have someone physically present in Jersey City. We have made arrangements to have a backup custodian, but I think for ease of use, our Jersey City facility is the best for our members. And I know a few of the members on this call are currently going through that process. So we have made contingency plans, and we do have employees that come on site from time to time to accept loans and to ship back out loans. I guess the only thing we would ask is just providing us a little more, a little more heads up than usual, and getting these loans in and out of the vault. But I think we've been able to accommodate fairly pretty much every member request to date. So we've adapted and overcome, and hopefully we can continue to support.
Okay, excellent. And also, I would add another question, Brian. You had mentioned that if members are interested in checking out the acceptability of certain collateral, just reach out. And I know that's that pertains to kind of the guidelines that we have outstanding already. Some members are asking, and we have already done this with the PPP loans. Or would we entertain accepting any other new collateral types, even on a temporary basis, to be accommodative during this crisis? So we had the regulatory approval to accept the PPP loans. Are there anything else in the works that we're considering, and are we allowed to accept from a regulatory standpoint?
Tom, that's spoken like a true calling officer with that question. I know you planted that one on me. Yeah, I thought PPP would keep you happy for a while, but
we're very happy.
The looming one, I kind of briefly touched on it earlier, was the fact that we're still dealing with mortgage paper, and I think that at some point maybe this crisis will spark a move to an e-note environment. It's something that the system in general is looking at. We haven't gotten there yet. We think we'll be able to get there. We really haven't had the demand for it. Now, when I say e-note, I don't mean, electronic signatures. I think they're specifically originated e-note that's kept in an e-vault, et cetera, and I'll happily field any questions. So there's something that we're looking at, and we think it's probably going to gain some traction in the near future. So that's one thing we're looking at.
All right, that would be a big, big positive going forward. All right, so I think we have a couple of questions in the hopper. Alyssa will field those questions to you, Brian. Alyssa, do you have a couple of questions for Brian?
Sure. Hi. The first is, if I have a swap interest rate derivative in place with national values sourced from our mortgages, does that affect pledging those same mortgages?
Interesting question. We recently looked at a loan where we had some swap language that was embedded in the mortgage note. Typically, we understand that members enter into these transactions outside of the mortgage transaction at the same time, but this is the first time we had seen it kind of embedded in the note. Did a deeper dive on that. We're not necessarily going to look at the swap value determining the mortgage value. We do potentially see some issues in liquidating that collateral, but at this point we're accepting those loans and we are not taking any additional haircut against those. But it is something that we're continuing to monitor.
Thank you, Brian. The next question is, has there been any permanent changes to the way that the FHLBNY accepts collateral? Will any of the accommodations be carried forward to the post-crisis environment?
Good question. I would say probably the biggest one is around the acceptance of the forbearance loans, and I was very happy that the regulator gave us the flexibility they did on that. And technically, we're allowed to provide liquidity against those for quite a period of time. However, I would think at some point those loans, and I think the members would agree that at some point those loans, there needs to be a end of the temporary forbearance, and some modification of the longer term note has to happen. So the value will drop as the time period marches on. So I say that's probably the biggest change for us. Also, the notion I kind of touched on a little bit on the on-site reviews is probably something we need to rethink in terms of working with members to get as much of the work done off-site as we can, and limit our sort of on-site role, minimize it going forward. So that's something that operationally that we'll be looking at over the next few months to a year.
Great. And then the last question we have is, what is the bank's position on forbearance program extensions for the FHLBNY interchange?
Yeah, I just kind of touched on that. We would entertain that. Right now, it's as long as the bank is offering that forbearance, we're accepting that. At some point, though, I think we're going to have to come to realization that loan needs to come out of the forbearance period. We're here to support, and I certainly would. We've supported 3-month forbearance. We've supported 6-month forbearance in certain circumstances. I think getting beyond that 6-month time frame would be challenging, and the value associated with that collateral would certainly decrease fairly substantially.
Thank you, Brian.
Is that it, Alyssa?
Tom, that's all the questions that we have. Yes.
All right, great. Well, Brian, great presentation. Really appreciate it. One thing I wanted to reiterate about our acceptance of the Paycheck Protection Program loans. So we do accept them. I know many are going to be pledging to the Federal Reserve. However, we do have something called the Disaster Relief Funding Program, a DRF, where we have $1 billion set aside for lending in FEMA declared disaster areas. So if you had a portion of those PPP loans that needed to be funded after you figure out what's going to be forgiven, if you utilize those, or many of those PPP loans can be utilized for the disaster relief funding, and that is considered, most of those would be considered qualified lending under that program. So that would entitle you or enable you to obtain a reduced rate under that program. So when you look at the cost of funding for or utilizing that disaster relief program with those PPP loans, the cost of funding would be a nice savings versus the Federal Reserve Bank's disaster relief liquidity. The PPP liquidity facility cost of 35 basis points. So you can achieve some significant savings. So if you wanted to discuss that further, please contact your relationship manager. And then that's all I have to say regarding that. But this concludes our session for today. We are having some follow-up webinars next Thursday and the following Thursday. That'll be to be determined, but we're going to be discussing credit, what members need to know regarding their the way the Home Loan Bank of New York looks at the credit of our members, and also we're going to be exploring the PPP collateral and lending a little more thoroughly. So we're not sure of the exact dates of those, but they will be next Thursday, the next 2 Thursdays, and we'll let you know what the order is. So thank you again, everybody, for attending, and look forward to seeing you next week.